Last week, Congressman Pat Tiberi, he's the chairman of the Subcommittee on Select Revenue Measures, a subcommittee of the House Ways and Means Committee, held a hearing on tax extenders. The hearing provided an opportunity for the subcommittee to hear about the merits of extending, or not extending, expired or expiring tax provisions. During the hearing, several lawmakers spoke out in support of the New Markets Tax Credit, which, as most of our listeners know, expired at the end of 2011. Those lawmakers include Representative Richard Neal, who is the ranking member of the Subcommittee on Select Revenue. Also speaking out in favor of extending the New Market Tax Credit was Congressman Erik Paulsen, Jim Gerlach, and Jim Costa.
Many of the tax provisions that expired in 2011 are priorities of mine. For example, New Markets Tax Credits and Build America bonds are very important. The New Markets Tax Credit is designed to stimulate investment and economic growth in low-income communities that are traditionally overlooked by conventional capital markets, and we've seen the result in all of our districts.
I'm also a co-sponsor of the New Market Tax Credit, which was mentioned earlier, and this credit would provide that 39% 7-year credit against federal taxes for investment in economically distressed communities. These credits go to areas that otherwise would not see investment or benefit businesses located in low-income communities. In my district alone, the credits have created about 150 jobs. The credit has been extended 3 times, and I believe it should be extended again.
The New Markets Tax Credit is designed to stimulate investment and economic growth in low-income, underserved communities that are often overlooked by conventional capital markets. According to the GAO, 88% of New Market Tax Credit investors surveyed would not have made the investment in low-income communities without the credit. According to the Treasury Department, every $1 of foregone tax revenues under this tax credit program leverages $12 in private investment in distressed communities on a cost basis. I'm pleased to be original co-sponsor, along with Chairman Tiberi, Congressman Neal, and Congressman Lewis, of H.R. 2655, and this bill would extend the credit through 2016 at a level of $5 billion per year in credit authority.
But I'd like to focus today on one tax extension which has been helpful to our constituents in the San Joaquin Valley, and that's the New Market Tax Credits. I'm pleased to have joined with over 60 of my colleagues on a bipartisan basis to co-sponsor H.R. 2655, the New Market Tax Credit Act of 2011. H.R. 2655 extends those credits for 5 years. I'd urge the committee to consider this measure and adopt it as a part of whatever overall package you produce. At the national level, between the start of the program in 2003 and 2010, going back to the Bush administration, the new market tax credits investments totaled $20.9 billion. During the project cost for the finance projects during that time, it was $45 billion around the country. I think that's a pretty good leverage in terms of investments that were made of significant capital from other sources. This financing was mostly located in high distress communities throughout the country. Around 60% were located in communities where the unemployment rates were at least 1.5 times the national average. In my congressional district, the New Market Tax Credit investments totaled $60 million in total project costs. It came to a value of over $114 million, over a 2-to-1 or almost a 2-to-1 ratio. This is significant investments in areas where capital investment is badly needed. So the leverage, I think, across the country and including my district is good. Recognizing the value of these new market tax credits in the San Joaquin Valley that I represent, I introduced H.R. 2740 last year, a bill that would help spur economic development in low-income communities. I'm aware of 2 situations that I want to bring to the attention of the subcommittee, and I'll close, that are adjacent to universities, both at Fresno State and the University of California in Merced, where no one has lived in certain census tracts at the time of the last sentence. But now, with the new census that has taken place, people live adjacent to these universities. So there was no information on income available from the last census that was taken in 2001. Now there is. There is a important student population that has taken residence adjacent to the universities. They're poised to continue development in that area to provide services to these students and to the university community. H.R. 2740 allows the new market tax credits to apply to where census tract information is not available or where a tract adjacent to two or more low-income communities did not exist. So I'd urge the consideration of this measure as a part of the larger effort that the subcommittee will undertake. It would benefit, in this case, these two university communities that are important to the education of our future, both at UC Merced as well as Fresno State.